Hello, everyone. Let's talk about the stock market. Maybe you've heard people mention it, or you're just curious about how those big companies do their thing and how some folks try to grow their money. Whatever brought you here, glad you made it. Let's start simple. What even is the stock market? Okay, picture this. Imagine a local bakery that makes the best sourdough bread in town. They're doing so well they want to open a second location. But here's the problem. They need money to rent a new space, buy ovens, and hire more bakers. Now, they could take out a loan, but loans mean debt and interest. Instead, they decide to sell little slices of ownership in their bakery to people in the community. These slices are called stocks, and anyone who buys them becomes a part owner. But wait, what happens next? Let's say you buy one of those slices. A year later, the bakery's reputation explodes. They're selling out every day, and people are lining up for their croissants. Suddenly, your tiny slice of ownership is way more valuable. But what if you need cash for, say, a new gaming setup? You can't just walk into the bakery and ask for your money back. That's where the stock market comes in. It's like a matchmaking service for buyers and sellers of those ownership slices. If there's demand for the bakery stock, you can sell your slice to someone else at a higher price. But here's the twist. The stock market isn't just for bakeries. It's for massive companies like Apple, Netflix, or Tesla. Instead of a physical marketplace, it's mostly online. A giant digital hub where millions of people trade stocks every second. Think of it like eBay, but for pieces of companies. Why do companies even want to sell stocks? Great question. Let's go back to our bakery. By selling stocks, they get a big pile of cash up front to grow their business. No loans, no debt. In exchange, they give up a tiny piece of control. For example, if they sell 1,000 shares and you buy 10, you own 1% of the bakery. But here's the catch. The better the bakery does, the more your 1% is worth. That's why companies and investors care so much about growth, innovation, and profits. Now, let's talk about the two sides of the stock market. The companies, they're here to raise money. Maybe they launching a new product, expanding to new countries, or just staying ahead of competitors. And the investors. That is you, me, retirees, or even big pension funds. We're here to grow our money over time. But how do investors actually make money? There are two main ways. The stock's price goes up. If you buy a stock at 10 and sell it later at 20, you've doubled your money. And the other way is dividends. Some companies share their profits with shareholders. It's like getting a thank you check for owning their stock. Why does this matter? Let's zoom out. The stock market is like the economy's engine. When companies get funding, they hire more people, build new factories, or invent things like smartphones or electric cars. That creates jobs, drives innovation, and, hopefully, makes life better for everyone. For investors, it's a way to grow wealth over time, way faster than a savings account. But wait, it's not just buying and holding forever. Let's add some drama. Stock prices change every second based on supply and demand. If everyone wants Tesla stock, the price shoots up. If people panic and sell, it crashes. This is where terms like bull market, prices rising, and bear market, prices falling, come from. Let's make this real with an example. Imagine two investors. Alex buys stocks in a solar energy company because they believe in green tech. They hold it for 10 years, ignoring short-term dips. While Sam buys and sells stocks weekly, trying to profit from tiny price swings. Both are valid strategies. Long-term investing, like Alex, is usually less stressful. Short-term trading, like Sam, is riskier but can be exciting. What about famous names like the NYSE or NASDAQ? These are just different stores in the stock market mall. The New York Stock Exchange, NYSE, is like the historic flagship store. It's been around since 1792. The NASDAQ is the techie, digital-focused store where companies like Google and Amazon trade. But here's a fun fact. Most trading happens digitally now. No more shouting on a crowded floor, just algorithms and instant transactions. Let's address the elephant in the room, risk. The stock market isn't a guaranteed money printer. Companies can fail. Remember Blockbuster? And stocks can drop to zero. That's why smart investors diversify. They spread their money across lots of stocks, like a buffet instead of betting everything on one dish. How do you actually start investing? It's easier than ever. Apps let you buy stocks with just a few clicks. You can even buy fractional shares, like 0.1% of a Tesla stock, if you don't have much cash. But always do your homework. Research companies, understand their goals, and don't invest money you can't afford to lose. Okay, recap time. The stock market lets companies raise money by selling ownership slices, stocks. Investors buy stocks hoping they'll grow in value or pay dividends. It is a mix of long-term strategies, short-term trades, and calculated risks. Final thought. The stock market isn't magic. It's just people, companies, and money connecting in a way that usually helps everyone grow. Whether you're saving for retirement or just curious, understanding it gives you power over your financial future. Anyway, that's the deeper dive. If this clicked, hit that like button. It helps so much. Got questions? Drop them below. Catch you in the next one.